Hi everyone and welcome to part 3 of this video series where we attempt to buy our first house in Auckland, New Zealand.
In this video, we're going to be meeting with our mortgage broker from Squirrel. We've never met before and we have no idea what we're in for.
Yeah, let's do this! Hold on a second, before we jump into the recording with our mortgage advisor, there are some important things to discuss first.
First of all, we are aware that this video is quite long, but our meeting with our mortgage advisor from Squirrel was so insightful that we decided to keep most of it as it is.
And honestly, really honestly, I wish there was a video like this when I was young because it turns out there's a lot of misinformation out there which we both followed for years and it turned out to hurt our application in the end. Adam from Squirrel said it much nicer. He said,
Yeah, and it's a pretty common misconception. Quite a lot of people will say to us.
But honestly, we were a little angry to find out that some of the things we thought would improve our credit score was actually doing the opposite.
Because in New Zealand, people's credit scores worked out differently to what you would commonly find on the internet these days.
We also asked Adam some very important questions, such as,
why are you guys called Squirrel?
But in all seriousness, we do cover a lot in this video, which may help with some of the decisions you make, even before you begin the house buying process. Some of the insights we learned from our chat with Adam would have been handy to know long before we began this process, so we do recommend watching the entire video because it is filled with valuable information.
However, an important disclaimer to note is that this video is our own and does not represent Squirrel's advice, position or opinion, and it is not intended as financial advice. Alright, let's get on with the video.
Good afternoon.
Hey Adam.
Hello.
How are we going, guys?
Good.
Hey, thank you guys so much for making some time. Massively appreciate you guys being quite so organised. It's incredibly rare that I have the opportunity to talk to someone already having an online application and basically everything I need to submit an application. So really today is not so much of an information gathering session for me. It's more a chance for us to have a chat, give you the opportunity to answer ask any questions that you might have, learn about the process, that kind of stuff. One of the bits of common feedback we get around, first-time buyers, it's hard to know what you don't know. And as soon as you start Googling things, quite often you'll come across things that aren't appropriate for a New Zealand context, or you'll come across information that directly contradicts one and the other. Yeah. And it's such a difficult situation to be in because you're about to spend, crazy amounts of money. It's so far disproportionate from your day-to-day kind of living costs that the money side of things is pretty terrifying. And so, when you jump online and you start Googling things, it's like, you don't really know what to believe. You don't know what's right, what direction to go. And it can be super, super confusing. There's no kind of consistent and reliable source of truth. And of course, when you go to a bank, you only see how one single bank does their process. So if you don't fit their kind of unique policy, then you get yourself into a bit of trouble because they won't tell you where to go and how to help yourself. That's kind of where we fit in, and I guess that's why I bring that up. Our role here is just simply to work with you, represent you in the eyes of the banks. We can work with one or all of the banks at the same time. There's no kind of limits in terms of what we do. And we like to position ourselves to be as impartial as possible. So from my side of things, I just want to help. So I obviously don't know what you don't know. So my best process is we kind of start talking through, where things can go from here, and just, always feel free to ask as many questions as you like. Interrupt me if you need to. If something doesn't make sense, totally call me on it and I'll go back and we'll kind of revisit things. Looking at your situation and certainly using the figures we've got on the application, it all looks relatively straightforward, which either means you're the perfect, template for a first-time buyer, or there's something else that we'll kind of uncover as we go through the process. Very, very common. There's no such thing as like a, classic template for someone going out and buying their first home. So I guess making sure I'm on the right page in terms of my understanding of things. Ideally looking at a purchase price somewhere around the 800K mark. And then we've got deposit of around 160K from a couple of different sources, which would give you 20% of the 800K purchase price. Now, being first-time buyers, you don't necessarily have to meet that requirement. Standard borrowers in the industry, the bank will say, hey, look, you need 20% deposit in order to buy a home. Not necessarily the case if you fit into a number of different categories, and first-time buyers is the most obvious exemption. You don't necessarily have to have 20%. So your 160 could support a $900,000 purchase price. However, if you go down that road, there will be implications around cashback and most importantly, your interest rates. So whenever you see interest rates listed online, they will always require 20% equity or 20% deposit. So if you buy with less than 20, then you start to look at low equity margins and low equity premiums. So the premium is just an upfront fee. The low equity margin is a addition added on to your interest rates. But of course, ideally, if you fit within that 20% deposit level, you're going to get the best rates. You're going to get the best level of cash back. And really importantly, it opens up the whole industry in terms of lender choices for you. The other consideration around deposit, which is super important. So standard process when you're buying would be, hey, look, we catch up, we talk through, what you're looking to do and what you've kind of got your eye on. We then can approach a lender or possibly multiple lenders to get your pre-approval. I don't like to scatter applications around the industry. I don't think that helps you too much in the pre-approval stage. Really, the pre-approval was simply around giving you confidence to go out there and start to, look at properties and potentially start negotiating on price. The pre-approval will last for 90 days. And once you secure a property, we can then also start to explore other options around different lenders. Some of the banks are pretty slow at the moment. So it can be beneficial to kind of have an application in progress just in case we need to go there. So we might look at it and go, hey, you've got this particular property in mind, you're looking to spend this amount, and therefore these two banks are probably going to be the best for you. So we might apply to both at once.
Right.
Cool. Do you have any kind of property types that you've got in mind or any places that you've looked at so far?
No, we haven't really gone to any open houses really, because where we're at now is we don't even know what kind of house to look at because we don't really know what people are willing to lend us. So we kind of held off looking at houses.
Yeah, cool. Yeah. No, and look, we can certainly give you some pretty decent figures today based on the conversation we're having now. So what I can do, affordability is probably a good place to start. I like to approach affordability in two ways. So one is how much the bank will give you. That's obviously important because it does set the real kind of firm parameters around how much you can borrow and therefore how much you can buy. Most importantly at the moment, and I think certainly we're in a high interest rate environment, interest rates are expensive, borrowing's expensive, and actually it's pretty rare that someone's really maxing out what they can borrow with the banks. It's more important to go, hey, look, actually your repayments are going to cost you X. And therefore, this is where we're going to limit you based on how much you're comfortable with in terms of your repayments. Does that kind of make sense?
Yep.
Yeah, cool. So what I can do is I'll share my screen with you. Hopefully that will come through all right. And I'll bring up our brand new fancy servicing calculator. So what you'll see in front of you is all of the major banks that we deal with on a day-to-day basis. So we've got ANZ, ASB, BNZ, Westpac, QBank, TSB, SBS, Co-op, and I think that must be, Sovereign. And what we've got in terms of the bars, this is simply the figure we've got on the application. So purchase price minus your deposit sources. And the little blue line through here is that level of borrowing. So as you can see, at 20%, we could literally go to any of the banks apart from BNZ. Mm-hmm. What you'll also see is the amount of borrowing changes based on who the banks are. And that's just simply based on their unique kind of credit policy. Cool. Importantly, if you want to go above the point where you've got 20%, so then you're in that kind of 15% range, your ability to borrow will reduce. So we go to 85%, all of a sudden all the bars drop. Mm-hmm. Now, KiwiBank have some pretty unique policies. So they will allow you to borrow more in the low deposit space. However, because you're not a KiwiBank customer, we will have to apply for low deposit funding there, and it's certainly far from guaranteed. Mm. Cool. Something we can explore if you're really looking to extend yourself. All of the others you'll see are kind of dropping down around, we've got 640 for ANZ. And what these bars are all calculated from is the figures that you've presented. So we've got incomes. We do have your interest income in here, which I probably will take out, but that will be dependent on how much history you've been earning this kind of level for.
Like an year at least.
Yeah, okay, that's cool. A little bit longer is always better, but it also won't have a massive impact. So if I untick that one, it's not going to change things hugely in terms of borrowing. These ones will be a little bit low, and I'll just quickly throw in your rates and home insurance estimates. So obviously when you have a home, your standard kind of fixed costs are going to be council rates and home insurance. Now those are just ballpark estimates based around something like an 800k purchase price. Obviously, the more you spend on your home, the more expensive your rates will be. And of course, the more expensive your home insurance will be.
Yep.
Cool. In terms of debts, obviously including your student loans and credit card details as well. Cool. Credit cards are an interesting one. Obviously, you both owe nothing, but the bank will still consider the limits of those cards. So if we take them out, as you can see, all the bars start to rise. And the reason for that is the bank will take typically 4% of your limit. So the SBS card with the 4K, they're basically claiming $160 a month in a regular expense, and they take that away from your ability to borrow. So that's why you have quite an impact.
I didn't know that. Okay.
Yeah, and it's a pretty common misconception. Quite a lot of people will say to us, "Oh, hey, we don't have credit card debt." Kind of end of story, but actually they've got a $10,000 credit card. It's just got nothing owing. And obviously, as you can imagine, a $10,000 credit card is going to have a big impact on your ability to borrow.
Okay. Learn something new. I was always told that having a credit card is good for your credit score.
Yeah, that's what I heard as well.
So really, once again, really common misconception.
Right.
Overseas, that will be correct. So quite often overseas, your credit score starts with 0 and you build up a credit score. So you get a credit facility and you make some regular repayments on time and you start to build some points. And normally you've got to have a certain number of points before you can kind of do anything, right? In New Zealand, it doesn't work that way. So we will do, the banks will do a comprehensive credit kind of report on yourself. And that includes everything that basically the banks can access. So utility providers, cell phone contracts, obviously, credit cards, student loans, all that kind of stuff. Anything that's, financial in your life where you've got some kind of, ongoing payment obligation will be linked into those credit scores. And what normally happens is that your credit score is perfect to start with. So we're the opposite. You have a perfect score and then you degrade it based on your payment behavior.
Wow.
So if you miss a payment, your credit score will reduce. If you default on a payment completely, your payment reduces even further. If you default and you have an unpaid default, then your credit just goes through the floor, is basically how it works.
Right. Is there a way to build it up?
Basically, you build it back up again by having very good, clean payment history.
Okay.
So if you're making all of your payments on time and, everything is kind of squeaky clean in terms of your payment obligations, then over time, your score will build back up again.
Okay.
So it's not uncommon for us to see people who have had bad credit in the past. But, quite often we'll have a chat. We might have this conversation and credit will come up and, we'll flag a few issues based on some of the things they've talked about. And then we can put them, give them a bit of plan and give them some tips and hints around how they can kind of get an acceptable score again. The other thing that comes up a lot is people who have unarranged overdrafts on their transactional banking. The odd missed payment on a direct debit or late payments on direct debits, they will degrade your credit score as well. So it's really important to make sure you're always meeting your kind of repayment obligations. So speaking of repayments, if you were to stick with that 800k purchase price, $640,000 in borrowing, standard loan term would be 30 years. And obviously, by no means does it need to take you 30 years to pay it off. But most standard loan terms are 30. And certainly in a high interest rate environment, it's not a bad place to start. And the best 1 year rate in the market right now, and I choose 1 year purely as a starting point. And I guess that probably is a good time to highlight, our involvement and my involvement in this process doesn't end. So we'll go through every single stage from, this conversation to the application, to negotiating with the banks, to negotiating pricing, helping you find properties, not necessarily from a real estate agent perspective. I don't consider myself a property expert, but what I will do is I'll comment on property from the bank's perspective. So if there's things in the sale and purchase agreement that banks might not like, if there's, property features the banks might not like, I can highlight those to you early in the process and kind of avoid you wasting, too much time on things that aren't going to happen. And then obviously once you've, right at the end of the process, when we're basically ready to buy, we'll start talking interest rates, we'll negotiate pricing for you, and then we'll have another conversation similar to this. We might have, say, half an hour where we talk through all of your loan structuring options. And you can fix, you can float, you can revolve in credit, you can offset. There's a bunch of different things that you can do, some of which may not make sense at the moment, so don't worry about it too much. But we can, guide you through that process. And it's not, there's no blanket rule in terms of what how your loan structure is set up. It should be based on you guys and your goals and intentions. So, you're buying your first home, and I would assume you're probably looking to be there for at least the first kind of 5 years. That's a figure I'm definitely throwing out there, and so keen to get your thoughts on that. But some of those kind of things will help dictate what interest rate structure is most appropriate for you. Of course, keeping in mind as well what interest rate forecasts look like over the next 6 months, 12 months, 18 months. And of course, most importantly, what your actual pricing is and what's affordable. Cool. So jumping back to affordability. So 640K, 30-year loan term, and a 6.85 interest rate, just to give you a kind of line in the sand. Now, do you guys get paid fortnightly or monthly?
Fortnightly.
Mm-hmm.
Fortnightly? Cool. So if we look at fortnightly repayments, always good to kind of line things up. You would be paying this figure here, so $19.35 per fortnight. So just under $1,000 a week. And that is obviously just your mortgage repayment. So keeping in mind your, council rates and home insurances. And of course, the other thing when you're buying a home, you're obviously taking on a big piece of debt and you're doing it together. So one other thing to kind of keep in mind when you're assessing your budget is, do you need to think about, income protection, life insurance, those kind of things, not necessarily protect yourself, but to protect your co-borrower, i.e. partner. If you couldn't meet your payment obligations for yourself, you want to make sure your partner can cope on their own. So those kind of things are super important. And there is obviously there is a cost involved in that. So making sure that fits into your budget is super important. So yeah, in terms of council rates, home insurances, you probably want to budget something in the realms of, $200 a fortnight. That gives you a $5,000 a year budget for rates and insurance, which should be more than enough. Property like that's probably going to cost you, maybe $3,000 in council rates. And then, something like $1,500 a year in home insurance.
Right.
Cool. Now, the other thing, the difference in the two lines here is just referencing some payment acceleration options. So down here, what it's basically saying, it just templates to give us an example. If you paid an extra $200 a fortnight off your loan, so that's basically going, hey, look, my minimum's $19.35. I'm going to increase it by $200. It's going to take 7 years off your mortgage. So that original, while we had a documented 30-year loan term, it doesn't need to take you 30 years to pay that off. And quite often what I really encourage is, certainly at the moment, interest rates are high, but in a year, 18 months or so, they will be down at a more comfortable level. And if, say, for example, they fall by 1%. So if we said 5.85, your repayments are now $170 odd cheaper per fortnight. But if you've got used to that higher level of payment, that $19.30 or whatever it was, then you should continue to pay that. There's no point just giving yourself extra money to, fritter away, unless, of course, you've got other investments you're taking advantage of that money with. If you don't, you can simply dial up your repayment and pay a little bit more money. So that's the best way to get yourself debt-free faster in kind of the most efficient, painless kind of way. Cool. Any questions on any of that?
No. Do you?
I just had a question around insurance. Obviously, home insurance will be mandatory, but I always assumed that life insurance was also mandatory for homeowners.
No, and it's really interesting that it's not. It would make perfect sense to me that, life insurance or loss of income insurance was, because basically you're taking on this big chunk of debt that requires both of your incomes to service it. But the bank, all they care is that your property's taken care of. So, hey, look, going back to some of those figures before, looking at that 800K-ish purchase price, that's absolutely doable. Based on the information you've presented. Obviously, I need to, go through and verify a few things. As long as you're comfortable with what those regular repayments look like. So, when I didn't have you guys in front of me because I was sharing the other screen, but, that $1,900 a fortnight, how does that sit with you? Obviously, that's going to be a bit more expensive than rent at the moment.
Yeah.
I mean, you guys are definitely saving some money. I've had a quick look through some of your statements. You're doing really well. And one of the things that I always really encourage people to do, and it's great when we get to chat this early on in the process, is if your repayments are going to cost you, let's call it $2,100 a fortnight. So we'll go repayments, council rates, and home insurance. If you're currently paying $960 a fortnight in rent, you need to be trying to save $1,150 a fortnight.
Mm-hmm.
Now, if you can do that and that's comfortable, then absolutely buy at this purchase price, because you've proven to yourself that you can afford it. You've also got what the bank would consider demonstrable affordability. There is appropriate money that's going into appropriate places, i.e. savings and rent, that can simply be redistributed or directed, should I say, into paying your mortgage. You're not going to be in that situation where you go, I'm paying $480 in rent. On paper, I can afford it. Therefore, actually, you can get an approval. And then you get the approval and you're like, wow, that extra $500 is really, really tough to find every week. And actually, this is not sustainable. Mm-hmm. That's where these kind of affordability conversations are super important early on in the process. So you guys can chat through it over the next couple of weeks and go, can we effectively save $550 a week? Mm-hmm. If you can, absolutely fine. Let's go for it. But actually, you may come back to me and go, you know what, that's too hard. But if we drop it by $100 a week, what does that look like in terms of a loan amount? And therefore, what does that look like in terms of our borrowing budget? Our purchasing budget. What the bank will give you is really not important. It's far more important to talk about what you guys are comfortable with in terms of repayments. Now, obviously, I should say currently a higher than typical interest rate environment. So interest rate, mortgages are expensive. The beauty of that is that property prices are pretty flat. So some people are making a somewhat educated risk around, I want to commit to a property now, I'll suck it up and pay high interest rates for, 12 months, keeping in mind that interest rates should be on their way down. Now, that is definitely an educated risk in the market at the moment, but you need to be aware of the fact that you are taking on a risk. There is, I don't know what's going to happen tomorrow, let alone in 12 months' time. Every economist under the sun has certain predictions, and there's a whole lot of them that are in alignment around what they think will happen moving forward. But they also change their minds every month. So that's where you've got to make sure that you guys, your household is comfortable, moving forward. The other thing we obviously haven't talked about is borders. I don't typically like to throw them out and encourage them, because lots of people will go, yeah, we'll get a border. Actually, no, we don't want to get a border. And therefore you end up in a situation where you've got kind of more borrowing than you really want to afford. So that is simply, I'll throw it out there to say, look, that's an option. ANZ and ASB make it super easy. You simply sign a one-page declaration that says, I intend to get a border. Ideally you do, and that's what helps you meet your mortgage repayments. If you don't, then it's simply up to you guys to make sure that you can afford your mortgage. Any questions on that? Obviously, I'm conscious of the fact that I've talked a lot. Anything you want to kind of clarify?
This is the part where we asked about the different loan structures that are out there. You can get a brief idea about them in the Squirrel First Home Buyer Guide. We read this before our meeting with Adam, and he did well clarifying a few things for us. But most importantly, he put us at ease. He conveyed that when it comes time to think about the different loan structures, he will explain them further. Right now, at the pre-approval stage, we don't really need to stress about the different loan structures, which we really, really appreciate.
I guess the big question I have is where to next? Like what do we do next?
Yeah, no, totally. And look, I think really it's going to come down to a couple of things, most importantly of which is a decision from you guys on how much you think you'd like to borrow. I can go up, we can put an application together today. I literally have absolutely everything I need, which I do love, by the way. And it's not going to take me long to whip one together. So we could get you a pre-approval, in the next 3 to 5 business days. And with that pre-approval, say for example, we went right to the limit. Let's go 640K in borrowing as your pre-approval. You can then choose how much of that loan you want to take. So you can take the next couple of weeks to decide, can we save that much money every week? Is that actually sustainable? Or does it mean that we're going to buy a house that becomes a prison because we can't live our life? We can't, go out for dinner and see our mates and all that stuff. So, what I would probably suggest is, I'll obviously post this. I'll send you through a big summary of what we've talked through. I'll include all the facts and figures and bits and pieces that we've discussed. I won't send you the first time buyer's guide because you've already got it. But I'll give you all the kind of figures and repayment details and things like that we've talked through. So, take those away and have a look at your budget, your kind of weekly living expenses budget, and actually see where that fits in terms of what you think is comfortable and sustainable.
Do you recommend getting a pre-approval first before looking at houses?
Yeah, absolutely. You don't need to necessarily have an approval before you look at houses.
Yeah.
But it really puts you in a position of power because you have absolute, written, concrete, solid evidence around the money that you can borrow. Mm-hmm. You also are then put in a position where you can have an unconditional offer. So if you see a property that's going to auction, you have to be in a position where you're basically unconditionally approved. So if you don't have your pre-approval in place, then we've got to start that process then, and it can really put you kind of behind the eight ball. If you want to, if you end up in a multi-offer situation, that's where, there's a couple of offers on the same property and you want to present the strongest possible offer, we can put you in a position where you don't need to include a finance condition. So if you don't need a finance condition, your offer is always going to be stronger than everyone else's because most other people need borrowing and therefore they need, 10 days to confirm their finance. Mm-hmm. Cool. Once I've done my assessment, I'll drop you an email and say, hey, look, based on everything that we've seen, we've verified all of your figures, we've submitted an application for X amount, and I'd be really happy that you go out and you put an offer on requiring that much borrowing. Once we get the pre-approval, obviously that gives you even more confidence around your ability to borrow. But if you find a property this weekend and it's perfect, it's within your price range and you're like, actually, here's my unicorn house, I want to grab it, simply let me know and I can talk you through the conditional offer process and we'll just make sure we're including enough time to get your finance in place. Just touching on, I guess, the conditional offer process. So if you want to put an offer on a home, before we've got an approval, we'll definitely need a finance condition, and that will need to be at least 10 days given the current market, possibly 15, and we can talk through that when the time's right. Your lawyer will also need to be involved. Have you engaged a lawyer at the moment, or have you got anyone that you work with? Okay, cool. That can be most lawyers. It's, property can be relatively general, but I always encourage you to work with someone who deals with property day in, day out. Someone who's got, real property expertise. There is some nuances about property that not every lawyer will be quite, 100% on. So, do definitely work with someone who fits that kind of category. And I can obviously make some recommendations there if it helps. Lawyer will need to, check all the property details, LIM, sale and purchase agreement, title, all those things, just to make sure that, from a legal perspective, you know what you're buying. You might want to look at getting a builder's report. And that's basically a, certified professional is going to come to the house and look at all of those details that you may not necessarily notice. And all of these things are really around making sure you're making the most educated and informed decision when you want to buy a property. In the background, I can work on finance and work with the banks to make sure we're getting you the best offer. In terms of your due diligence, I normally encourage people to have at least $5,000 for due diligence. It's an expensive process. Your lawyer could easily cost you $2,000 or $3,000. When you've got 20% deposit, you shouldn't need a registered valuation. So you might have seen that pop up in the first time buyer's guide. Mm-hmm. And your builder's report might cost you between $700 and $900, depending on the type of report that you need.
Mm. Right.
Cool. All that money will obviously be reimbursed with a cashback from the bank, but you'll need to pay for it up front. So just make sure you're kind of budgeting for that. When you put your conditional offer on, there's, you basically can tick off some conditions based on what you need. So it could be finance, it could be builder's report, could be just a general due diligence condition. And that just gives you a really good kind of blanket layer of protection so that if you find things that you don't like, regardless of where that's kind of come from, you have the ability to cancel your offer.
So in this process, will you be, like, I know you're a mortgage broker, but would you be helping us guide through each step? Like, this is when you need a lawyer, this is when you should do the building report, and this is when you should, right?
Yeah, totally. And that's, I think, that's the beauty of working with a broker, right? We just basically work through you to guide you through that buying process. Yeah. I'm not a lawyer. I'm not going to inspect the property. There's lots of things that I can't do, but we've got a good network of people who can support, the majority of which, in fact, I'm pretty sure all of which we don't have any kind of professional relationships with. Yeah. They're just good people that we work with regularly. So, try and keep ourselves as impartial as we can. So, I will absolutely say, hey, look, when you're looking to put a conditional offer on, these are the things that you need to do, and these are the people you need to have involved. Generally we can make recommendations on who you could work with, but you're free to work with whoever gives you the most comfort. Right. As I say, this process is all around giving you the confidence to take that leap. And so it's, if you've got a family recommendation on a lawyer, someone they've used before, absolutely go for it. It's around getting you the most peace of mind possible. Yeah. Awesome. Anything else before we leave it there?
Yeah. This one last question is a very important question.
Uh-oh.
Why are you guys called Squirrel?
So I've heard a few stories around why we're called Squirrel. I think the one that is most likely to be true, and I don't know because it was 15 years ago, right? Yeah. I mean, squirrels are, kind of fun, kind of cute, kind of quirky, mischievous little, kind of little problem solvers. And I guess that's kind of, it aligns with us, and how we operate, right? We try and be fun, we try and be helpful, we try and solve problems, all that kind of good stuff.
Right, okay. Okay.
And it's it makes for a good story, right?
Right. Just needed to get that from a source.
Yeah.
Yeah.
I'll speculating for a long time.
Totally. I mean, we could make that up. We could make up something far more fun if you want to go there.
Have you heard? My theory was squirrels go and hide their nuts because I have a deposit. I have the high interest yield savings account.
On call account?
Yeah, and I was like, maybe that's what it's referring to. I don't know.
See, funnily enough, Squirrel Money came after Squirrel Mortgages. So if Squirrel Money was how the business started, that would make perfect sense. It's like, come and hide your nuts with us. We'll keep them safe. Whereas no, Squirrel Mortgages was the first one. Squirrel Money's only been around for about maybe 7 years, I think. And actually the on-call account's only been around, I think, for 2.5. So yeah, great theory though. I do like that. That's quite good.
Yeah.
Interesting. Okay.
I should float that one by marketing and give them some inspiration.
Awesome.
Love it.
Yeah,
awesome. Yeah. Hey, thank you so much, guys. Nothing else for today before we leave it there?
Nothing for me.
That's all for me. Yeah.
Thank you so much.
Yeah. Perfect. No worries at all. As I say, feel free to fire through any questions at all that you need. My role here is literally just to guide you through the process. So if there's anything you need, anything you're not sure about, any questions, just fire them through. Happy to help. And you, of course, will hear from me in the next kind of 24 hours or so with a bit of an email summary, and we can go from there.
Sweet.
All right. Awesome. Thank you so much, Adam.
Thanks, Adam.
Hey, cheers, guys. Catch you later.
Bye.